Welcome, everybody, to another episode of the Good Deeds Note Investing podcast. I am your co-host, Jamie Bateman, here with my fellow co-host, Chris Seveney, and we are joined today by a special guest, Steven Burke. Won't get that wrong again this time. Steven is joining us here he's with Phoenix Notes, his note company, and he's joining us here as a follow-up to an episode we did a couple months ago. So, Chris, Steven, how are you guys doing?
Good, Steven.
Doing well, Jamie. Thank you. It's
Yeah.
here in Wisconsin by the Twin Cities, we got frost now. So I thought the cool nights were over, but it was like 35 this morning. So
It's been a
we're
little
still getting
chilly
it.
here too in Maryland. I'm sure it has for you too, Chris. A little chillier than usual.
Yeah, it has gotten a little chilly in the mornings. The afternoons have been nice and so forth. But other than that, fired up Friday like usual. Jamie's used to it already. Jamie's like, uh-oh, what's Chris going to come up with today?
Steven texted me this morning. It's about right now. It's about 8:08 a.m. Eastern, and he texted me. He said, "We're on in 45 minutes, right?" And I said, "Yep." Chris is often chomping at the bit by 7:45, and but then I said, "But he's chomping at the bit 24/7, so don't worry about it."
Yeah, I'm a little tired this morning. Thursday nights play cards with some buddies online, and we were up till about 12:30 last night. So, but
nice.
Playing some pitch. But this morning, people watching this on video, I'm proud of myself because I've been able to get now 3 of us on the screen right now with the new software we've been testing out. Last week we were able to get 2, which isn't up yet on YouTube. Should be up this week. But it's nice to play around with new toys. I guess it's always fun.
Mm-hmm. Yeah. So, Steven, what do you want to talk about?
So let me hop in first, because I feel like all this energy I gotta get out this morning. So we had Steven on about a month ago or 2 months ago, some time ago, not long ago. And Steven was just in the process that time, kind of going through his first note acquisition and really getting up and started in notes. And since that time, he's bought a note and started to get an understanding of the process with working with the servicer, getting it boarded, a lot of those aspects, which I think is very important for note investing because it's not anything really you can be taught. I mean, people can go through the steps, but it's, something where making sure you got the right forms, right paperwork. It's a bit of a nuance, and you have to kind of get in a rhythm and understand the servicer and what their requirements are, which pretty much are all the same, but it's just something that you can't just pick up a book and read of how to board a loan or how to get started on a note. So we wanted to bring Steven on while it's fresh in everyone's minds to really just share his experience, and we're going to pick his brain. We're going to throw questions at him that he probably doesn't know are coming, but he's going to, I'm sure, do very well in answering I'll say, coming from the firing squad. So
yeah, but we gave him only 5 minutes of warning last time. I feel like this time we might have given him too much warning. He might get
that's
scared.
true. Yeah, this time, I mean, we gave him, like 2 weeks, I think?
Yeah, I think so.
This one was actually on the calendar, so.
Yeah, so we'll see.
Yeah,
we'll see how you do.
We joke, but we're like, hey, what are we going to talk about today? And we pre-planned some episodes and stuff, and we're like, I don't know. And Jamie's like, yeah, let's see if Steven wants to hop on. So literally texts him 5 minutes before. And I was like, hey, you want to be on the podcast? So
yeah,
Steven,
You guys he tried to do that 2 weeks
I tried
ago,
this
but
time.
I had a
work.
conflict, and I was like, no,
Right.
but we can push it out a little bit.
Yeah, well, Steven, why don't you tell us a little bit more about yourself? And wasn't the last time, I mean, the excuse was something like you and your wife just had a baby or something? I mean, nothing that major or anything like that, but we'll give you a pass on it, I guess.
Yeah, I think last time, so it was, I think around 3 months ago, actually, when we last talked, at least recorded. And yeah, my wife at the time, I think, was probably 36 or 7 weeks pregnant at the time. So obviously since then we had our second baby, which is a girl. Her name's Lucille, and today she's 2 months. So time goes. Thanks. Yeah, time goes really quick.
Especially at that stage.
Yep, it's a blur, but no, it's going well.
And you've been able to keep your eye on the note business even through all that. That's impressive.
It's pretty brave to go through go start a new business with a wife who's 36 weeks pregnant. God help you.
Yeah. I don't think you're ever fully ready to be a parent or a note investor for that matter. But
No, exactly. So you just do them both at the same time. Kind of, I like this
knock it
guy
out,
actually.
rip off the Band-Aid. Um, yeah. So Steven, tell us a little bit more about your personal situation and your background. I know we already touched on that last time, but just for those who didn't hear that episode, a little bit of kind of how you got into notes.
Yeah, sure. So it kind of all started out, I'm an engineer by trade, so graduated from the University of Minnesota with a chemical engineering degree, and my wife was also going to school at Minnesota at the time, so we graduated with some student loan debt, and so that just kind of led to me researching around investing, personal finance type subjects, and you do enough exploring in that arena, and obviously real estate investing comes up pretty frequently as a really good option and a way to build wealth. So I got more interested in real estate, looking at, Bigger Pockets is also, or obviously a great resource. So I was looking into that, and then this subject of note investing came up, and I think the first thing I read about it was actually around Dave Horn's, some of his Bigger Pockets posts, and then eventually he came out with that note investing book that I read. And that kind of spiraled into, Jimmy Napier's Invest in Debt and a bunch of other books around note investing. And I just found the finance world or the paper world more interesting than kind of the hard real estate. I mean, obviously there's pros and cons to each method and strategy, but I think just from a personal standpoint, I find all the options that you have with notes, the different exit strategies, kind of the financing game, more interesting than the hard real estate. So that led to, me reaching out. I was laid off last summer from work for 3 months just because of COVID and furlough and cutbacks. And at that time, I had reached out to, I think actually both of you, both Chris and Jamie,
Yep.
asking if they needed any support or help with the business. Again, in my W-2 job, I'm pretty process focused. So, we do a lot of like process documentation, work instructions, that type of thing. And obviously communication is a big part of that. So I just kind of reached out, seeing if they needed help, and at that time, both of you guys were kind of set, but personal circumstances changed for Jamie later in the summer, just again with the stay-at-home work. I think his wife ended up staying home with the kids for schooling and stuff, so he had needed help at that time. So I just kind of jumped aboard and was helping Jamie with his business and the kind of the contracting work side, and then eventually led me. So I actually started my business. I registered my LLC last year about this time. So I had the LLC for a long time, did nothing with it until this past January when I bought my first note. So there was a period of time where I was researching and just kind of preparing for that first purchase. And I think just being involved with Jamie's business kind of built my confidence, built my knowledge base, and allowed me to kind of jump in this year to start purchasing notes ourselves.
So you were able to learn what not to do? No, I'm kidding.
Well, both. Yeah. What to do and what not to do.
First question I have is, at what point are you going to say, Jamie, thanks for all the assistance, but now I'm going to go do it on my own, and I'm going to be bigger than you? So when's that coming? When do you anticipate that coming?
I don't know. That thought process hasn't really happened yet, to be quite honest with you. I still find a lot of value, and I mean, I hope Jamie still gets value. Like I put in, I don't know, like 6 hours a week now, so it's not really what it used to be. But
I just sent your ACH. I just sent your payment for the 12 and a half hours you did in the last 2 weeks.
There you go. Yeah. So I don't know. It's hopefully he's still finding value in the limited time, but no, I guess I don't have any intention to stop as long as Jamie continues to think it's beneficial.
But in all seriousness, and we touched on this last time, but I do think it's worth reiterating. People they might look around and say, I don't have much time, I don't have much money, and I can't get into notes or real estate because of these obstacles. And you still don't have a lot of free time, but the limited amount of free time you have, you decided to add value to someone else. So we touched on it last time, but I just like to bring that up because people will drop questions in the Facebook groups or say, gimme, or what's in it for me. And, you approached it in a different manner. You approached it with what can I bring to the table? What are my strengths? And so I think that's starting to pay off for you.
Yeah. I'll just touch on the time thing a little bit. I don't know. It's interesting. It always seems like whatever you have going on, you can kind of make time for it. And it's just a matter of prioritizing. I know obviously you guys are both very busy as well and have stuff going on, but with just the new family, and I'm actually training for a marathon too, so I'm running like 50 miles a week now. So it's like,
Look at Chris's face.
How do you
right?
How do you
Yeah. Actually,
balance
let
everything
me.
I don't
going
like
on?
driving 50 miles, but actually,
I
I
need
used
to.
to love to run, but I've got, my doctor's like, anytime you want to get your knee replaced, we can do it. But you realize it's only going to last you 20 years because I've had 3 ACL surgeries. So my knee,
I
I
do
go
need
for a
to
walk.
chime.
Yeah, go ahead.
I'm sorry. So I do need to chime in quickly though. This was probably 6 months ago, Steven. You texted me on a Saturday, I think, and said, "Oh, I ran a marathon today. So do you have any?" Now I've got some free time. Do you have any projects for me to work on or something? I'm like, what? I didn't even know you had ever run more than 2 miles. So that was pretty impressive.
Yeah, I don't know. Like back in August when I don't know, I seemed to start maybe with Jamie and the marathon training at the same time. I don't know. It's maybe not as
Well, you're
smart.
running
That's
for both of us.
looking back, it's not as intelligent. But yeah, I don't know. Again, I think
No,
it
that's
just
good.
whatever you prioritize,
Right.
you
You
just
can make
find
time
ways to
for it.
make time for it. Yep.
Absolutely.
So, a few questions I have outside of running marathons and so forth. Since that time, whether it was 2, 3, whenever it was last time we talked, you bought a note. Full disclosure, you bought it from me. And before he asked, he's like, "Can I mention that?" I said, "As long as it's still paying you, you can." No, I'm just kidding. So what
we can edit things.
Yeah, we can edit a lot of things. What was the biggest, the thing that you thought? Well, let's start with what did you think was going to be very difficult or challenging? That was like, wow, that was pretty simple. Was there any process or anything that you thought was much easier than you anticipated?
Yeah, I think so. Like if you bid on a note and paper stack, they show you all those different steps to close, and you got to complete all these different actions. And I don't know, Chris, how much work you did on your side as the seller, informed seller, but I basically just signed some documents that came over, and things were pretty much taken care of. So I kept it with the same servicer that it was at, so there wasn't any really major boarding or transferring for servicing. So the overall process, I think, was smoother than I expected. And actually, I have purchased a second note through PaperStack, so that one was maybe a little bit more involved from a process standpoint. But again, that PaperStack checklist and notification systems is really, really slick and really walks you through what you need to do. So I don't know, it's kind of calming, I guess. I'm pretty detailed, so it's like I do worry about are all the proper steps getting completed, and I think in both cases for my current purchases, it's gone pretty smooth.
Yeah, I think, PaperStack is very good at how they systematically do things and put out the process. I do think from a time perspective, it does take a lot longer to close a note on PaperStack than if you're doing it outside with for like Steven and I, it was, okay, you do due diligence. Yep, you're done. Great. Here's a loan sale agreement. You signed it, wired me the money. I mailed you, usually within 2 weeks, I try and get out the assignment and, any other collateral that I owe him, get that out the door. And basically, you're kind of done where, with PaperStack, they do add kind of an escrow. They can do the collateral review and some of those things, which are good for new note investors. Don't get me wrong, but it does take a little bit longer. So just for people to, if you're a seller looking to sell on PaperStack more, just be aware of it. It might take a little bit longer. And for buyers, like I said, they put the steps in order. So it's something that you can follow. So that's one part of it. What did you find to be a little more challenging, if anything, as part of the initial boarding process, or just overall the last 3 months owning this note?
Yeah, I think like you mentioned, Chris, just the process through PaperStack does take a little longer than I anticipated. I think the biggest challenge is just with the servicing transfer. I hadn't really heard any information or I didn't see any emails come through about like just the communication between the servicing companies. So I had to follow up quite a few times just to understand where the process was at. I'm boarding right now with Madison, so it was like checking with Madison saying, hey, have you heard from the previous servicer and whatnot? And so there were some communication gaps, and eventually I just had to contact the seller to get me some updates, and then talk to the previous servicer, and it's supposed to transfer Monday to Madison. So we'll see if that happens. But I think just trying to understand where the process is at from a boarding standpoint and the servicing transfer has been the most challenging. Again, it's like I didn't see any emails between the servicing companies, so I didn't really know what was going on. I had to give them a call.
So
yeah,
there you go. And I'd be curious to have you on a third time in a year or so to see what you say about this. But sounds like you left your first note at the same servicer, and then the second one you're transferring to that same servicer. So both of your notes will be at Madison. It sounds like.
Yep.
Is that, I guess that was the approach you wanted to take as far as just having one servicer, one point of contact for your assets right now?
Yeah, I just think with, Jamie, the work that we've done with Labrador, I think Madison's been pretty good as far as communication and stuff with me. So I think I felt the most comfortable going with Madison. And the servicer that was servicing the second loan that I purchased was not one of the ones that Labrador Lending uses. So I guess it was more of a known versus unknown decision. And I just decided to go with maybe what I was more comfortable with or what was known to me.
Yeah, makes sense.
And I would recommend also for people getting started, it's kind of the catch-22. If you use two different servicers, you can kind of weigh the pros and cons of each one. But on the flip side, depending on how much time you have, it's, if you're limited for time or you've got the W-2 and you got other stuff going on, like 2 kids and all that other thing, mumbo jumbo, I think you're better off leaving it with one servicer just because typically it's one point of contact. It's one portal to log into. It's, from getting payments and invoices and everything. It's just one, you're dealing with one vendor versus 2. So, it's something that you have each individual investor starting out has to weigh the pros and cons with that. For me, if somebody was getting started and saying, hey, I had 1, 2, 3, 5 notes, I'd say probably start with one. And then if you get a one-off that's at another servicer you want to try, then maybe just leave that one with them just to kind of get a feel or grasp for how they do, their accounting processes, their loss mitigation, their reporting, because that's all very important.
Yeah. I mean, there is some risk, I think, in switching servicers. There's some cost, and, you never know if your borrower's on automatic ACH, maybe you're better off just leaving it alone, not switching servicers. But but I do agree. If you've got a lot else going on in your personal life, just have one servicer. So now both of your deals that you're almost closed on, I guess you've closed on. I guess the second one is a switching servicer is boarding next week. Is that right?
Yep, Monday. Yep.
Okay. So, and are they both contracts for deed?
They are both CFDs. Yep.
Okay. So I was just curious if was that also something you weren't afraid of because of, we've dealt with a lot of CFDs, and so you're already familiar with that, or, what was your thought process around whether to jump into CFDs or not?
Yeah, it's a good question. I think, for the first one I bought, I was just looking to purchase a deal, so I guess I really wasn't too picky, note mortgage for CFD. And it was a performing asset. So I honestly, right, wrong, or indifferent, didn't really consider the difference between contract for deed or note for that one. The second one, I was maybe a little bit more aware because it was non-performing, or it is non-performing, I should say. And I was going back and forth with the seller quite a bit just around the status of the loan, like what happened to it. And what led me to kind of go forward with it at the very end was just, he said, we just had communication with the borrower and he really wants to do a loan modification and convert to a note mortgage. So and the plan for the CFD for this one is to do a conversion over. And so that, was, because it was kind of part of the consideration, but because the borrower currently has interest and is in communication with the previous lender, I didn't really put too much weight on the CFD. So we'll see how it pans out. I mean, it's not obviously converted yet, and I know that sometimes a struggle, but the plan is to convert that one over to a note mortgage.
So
got it.
A few tips I'll give you on converting, and I've shared these probably 1,000 times with people. When you get the documents, find a local mobile notary and send them to them, and then have them bring them over to get everything notarized. Because if you put them in the mail, what will happen is, we're recording this in the middle of April. let's just say you sent them out today. You'd probably have to put a first payment due on June 1st because May 1st ain't happening. I mean, if you looked at now, there's no way you're getting that back by May 1st. I could tell you that right now with 2 weeks. If you got back by June 1st, you'd be lucky if you mailed it to them. If you got a mobile notary and say, hey, I gotta get this thing done by May 1st, you put it in the, send it to them, emailed it to them, they print out, you'd have it by May 1st in that instance. But if you put it in the mail, it's one of those things where, oh, I never got it. It sits on the table. You got the tracking number that shows they signed for it. But then, oh, I don't know where to get a notary. I don't, it's a process that I had one of my first ones took like 4 months and had to change the paperwork like 3 different times because, then I realized, idiot me. It's like, oh, why don't I just get a mobile notary? So takes me a while
Steven,
to learn.
Steven's been pretty hands-on with our conversions as well, so that's been good. And nothing is foolproof. Even the mobile notary during COVID, we tried that, and
we played that game.
We played that game, but it's just it's a good thing for people to understand. You gotta oversee the whole thing. It's not as easy as snapping your fingers and I'm just going to convert this. And
so
go ahead, Chris.
I was going to say, Steven, as part of working and kind of getting some of that mentoring from Jamie, or you mentoring Jamie, whichever it may be, have you found that to be beneficial? Because I'm listening to this right now and I'm stepping back for a second thinking, this guy's on his first asset and he's like, boom, I'm going to convert this and so forth, which that's kind of a that's an advanced strategy, I would say. And I know some, long-term note investors who buy a lot of CFDs and they don't, kind of get to that point. So I'm guessing this is, I don't want to put words in anyone's mouth, but I'll let you answer the question. But, and again, the question is, has that benefit of, working, with Jamie on this helped at all with your note purchases and some of these strategies?
Yeah, absolutely. 100%. So
it's the right
it's
answer.
Kind of funny, like the conversion process. It's just when I joined Labrador Lending as contractor, that was kind of an initiative that Jamie was undertaking. So I just thought that's what you tried to do, or I guess I still do that. It's like if the borrower's willing and it makes sense, let's try and convert it because it's less risk on the lender. And so I never really considered like, is this an advanced strategy or not? It's just like, well, if they're willing to do it and it makes sense, let's try and do it. So obviously Jamie's been a great resource for us, as in Phoenix Notes for the process stuff. So I feel free to, I always bounce questions off him if I have them. And he's got obviously a lot more assets and a lot more documentation, and he's been through it. So the files themselves have been great references for me to go back to if I have any questions around, well, how did he do this conversion? What documents were involved, or any of those questions. I have a really great place to go for references, not only in Jamie himself, but in the files and the existing assets that he has.
And question and follow up that, how much did Jamie pay you to just make those statements?
The contract pay maybe is enough.
Okay.
No additional.
So one, and kind of, I know this topic started with, kind of this segment has been the early trials and tribulations of a note investor. But it's interesting, my brain, which is pretty crazy, is leaning me towards the experience you're getting also from Jamie, because like you throw things out there, like, the collateral and stuff. I'm guessing, and I'll ask the question again, are you being experienced like a lot of different collateral files and a lot of different loans? Like, for example, is Jamie, had you look at any of these assets in the Empire State, which are assets he bought from some wonderful note investor that Jamie's going to make a lot of money on? Have you had any experience with any of those? And are you getting to kind of see a wide vast of assets as part of, dealing with Jamie?
Yeah, I'd say I get a lot of exposure to a ton of different scenarios. So yeah, I've been pretty involved with the New York stuff.
Can I get credit for that, by the way? Because I started and basically said, Jamie, here's a nice package, beautifully wrapped loans for you. Here you go, all yours. I'm going to be a good guy here and just sell these to you at a wonderful price so you can go right off into the sunset and retire.
still working on recording a couple of them 6 months later, but anyway.
So, well, yeah, hey, you got my documents. Well, no, yeah,
Yes.
you got what I need, but it wasn't filled out right. And
No, I'll just jump in. Steven, definitely. When you started, we were doing a bunch of conversions. We were doing a lot of FPI. We were taking over the letter cycle on insurance. And I know we talked about that on the last episode. There was a lot going on. Even, I know we don't have 250, 300 notes like Chris does, but we had a lot going on with our portfolio at that time. So, and you've worked, Steven works in, I'm not afraid to delegate anything. You've had exposure to pretty much everything we have going on. And even recently, I'm getting you more involved with the books and things like that. So, I guess it may sound like tooting my own horn. I don't know, but I would think from your perspective, it would be very, very helpful for your own note business growth. So, question: you started out with a performer from Chris, and then you kind of pivoted, whether intentionally or not, to a non-performer. What was the thought process there?
I think maybe going in the non-performing route is just, again, a way to expose me to different scenarios. And I think, you can buy performers at 10, 12, 13% return, or you can go in the non-performing space. And I think my initial thought process was, if this is going to be a longer term, side business or potentially full-time thing in the future, eventually you're going to have to go non-performing. And so I was kind of keeping my eye both on performing and non-performing assets, and this one came up that I was interested in, kind of fit my criteria, and so I decided to go through with the process. But I think eventually, again, maybe it's confidence that I've gained with Jamie helping you with all of your assets, but I just think eventually, if you want to do this, you're going to have to get into the non-performing space, and so that was my thought process.
So speaking of thought process, walk us through your thought process, and if there are any differences on the performing loan versus non-performing loan, because I like to ask this question to newer investors. Take us back to what intrigued you about the asset, a little bit of info about the asset, state. You don't need to give addresses and all this stuff, but the state, kind of some of the numbers behind it, what your thought process was, how you went through the bidding, the negotiation. People like to hear those stories because the first time you try and negotiate a note, it's kind of a little scary. It was like, trying to negotiate, and, I wasn't a great negotiator. So it's, something people just haven't done before. So usually they're a little more timid to process. So can you share some of your thoughts on that?
Yeah, so I think, I initially had my criteria to look for assets within the states that Labrador Lending has or Jamie has. And this one is actually not in a state that Jamie has bought a note before. So I don't know, there was some initial thought there. But obviously it didn't really pan out that way. And as far as criteria, I was looking for something on the lower end. So, under 50K or so UPB for a non-performing asset, just because, again, just starting out, we're a little low on the capital side. And I know we talked about this last, but raising out is just not something that I feel extremely comfortable with. So I wanted to use our own capital.
What was that? What was that you just said?
You want me to repeat? Sorry.
No, I'm sorry. What were you somewhat uncomfortable with?
Oh, I was uncomfortable with raising money for deals that I don't really have experience in doing yet. So I wanted to use our own money.
Makes sense. No, I think the internet locked up for a second there. I was just
going to change something real quick.
Gotcha. So yeah, and since we touched on that, as much as you're comfortable speaking about it, how are you funding this business? Or, I guess, it's more for the listener. How much do you think somebody needs to have available to get into note investing? Or, where do you see the future going for your business as far as funding and access to capital?
So try and break that. I'd like to break that down in 2 questions. How much did you start with? Because I think that's important. And he mentioned he wasn't ready to, go out and raise capital, which is a smart thing, something we highly recommend. And then, let's talk that. Then I'd like to, have probably a 5-minute discussion later on about where you think you see yourself going in the next 6 to 12 months.
Yeah, so for these initial deals, my wife and I had saved up some money, just every month putting money aside from my regular income into like an investing account. And so
Mm-hmm.
I would say the majority of the funding for the first one came from just personal savings.
Mm-hmm.
And then because I was impacted in COVID and I don't know, I'm kind of an anti-stock market guy right now. So I cashed out my 401k. So I would say
Mm-hmm.
the majority of the funds for the non-performer came from 401k distribution that I took from my W-2. So
Mm-hmm.
those were kind of the two ways that I funded my current notes.
Mm-hmm.
Um, Similar to Jamie, I do have a kind of an infinite banking life insurance policy. So we do have some money in there that we have not tapped into yet. But depending on deals that come up, we're more than willing to dip into that as well to fund additional purchases.
But overall, somewhere probably between 20 and 50,000, roughly, if I were to throw, kind of a spectrum out there.
Yeah,
Yep. So,
yeah, I would say so. Both of my purchases were right around 20,000.
okay. So and I like to share that, and again, without getting too details, personal information, but a lot of people think that you need 100 grand or, all this money to start. You do need to keep some money in reserves, especially on the non-performing ones in case it does go delinquent. But on the performing ones, you got that money coming in the door. It's got payments coming in. But this is a business that, you can start with, you need money. I would
Mm-hmm.
not recommend somebody just, not have any money or use credit cards or other things
Right.
for starting any type of business, no matter what type of business it is. But it's something that is, I think, less capital intensive, especially depending on where you live, than traditional real estate. Because if you had to put 20 to 25% down on a rental property, to get typically decent rentals, you're going to be, in six figures. So you're at the 20, 25 grand right there as well. And then the cash flow and leverage, while it has the tax benefits, it can also be seen maybe potentially at a little higher risk depending on when you're buying it, especially in today's market. I think you're buying it a little higher risk because of just all the unknowns.
Mm-hmm.
So.
Yeah. So no, I think it's a really, really good approach you've taken. You've got a performer, non-performer. You also have a partial that we haven't talked about, but so,
Yeah.
Who'd you buy that from?
I bought that one from Jamie.
Yeah, that one's in. So you've got what, the partial's in Mississippi. Where's the one you bought from Chris?
Mississippi.
Okay, so a partial and a performer in Mississippi, and then a non-performer in Tennessee. Is that right?
Tennessee. Yep.
Okay.
Good states to start with, by the way. You don't own anything in Tennessee, Jamie?
No, I know.
Oh my! You got to get on that, buddy. Tennessee, awesome state to buy notes in.
So why do you say that, or either one of you? I mean, I know you mentioned the states, Chris, but I mean, that's definitely a key decision. I recommend people look to maybe 3 to 5 states to buy in initially. What are your thoughts on that, Steven, as far as states or going forward, or your thought process already up to this point?
Yeah, so like I mentioned before, just with the states that Jamie you have through Labrador was kind of my initial criteria, just because you have experience. So I figured he'd be a good resource to talk to about things that would come up. But the Tennessee decision was more, I would say, like Facebook group related. So I've seen stuff around Tennessee and know that it's a fairly popular state to buy notes in. So I try not to put, this might be bad, but I try not to put too much thought into it, especially at the beginning. For me, it's just better for me to jump in.
Mm-hmm.
So right, wrong, or indifferent, that's what I did with this Tennessee.
Yeah.
So
Chris, why do you like Tennessee?
I have 10 assets in Tennessee. I just looked it up. It's a fast foreclosure state. It's very cost-effective foreclosure state. I got one right now, actually, that has been delinquent for a significant amount of time, and we're actually missing 2 of the allonges. But because we have the original note and it's a deed of trust state, missing the allonges, as long as you have the original note, really doesn't play into that. So it's a little more lenient on the collateral side of things as well. So kind of weigh those factors in. Now, I'll be honest, contract for deeds versus notes really are somewhat irrelevant in Tennessee because, it's such a fast foreclosure state. So I prefer, honestly, I've got some contract for deeds, but I prefer notes in states that usually are the non-judicial side. Granted, if there's any equity in the property and they're delinquent, you might be able to, in certain states, be able to capture that. But it's very rare that I've ever had CFDs that the equity was significantly higher than what they owed. It, maybe happened, and I've had, hundreds of CFDs and probably count on one hand how many times that's occurred. But yeah, and from got good attorneys in Tennessee as well, because that's I'd say important to understand who your attorneys are in those states. But I mean Tennessee, Missouri are two states I really like. Down in that that southeast area, that corridor.
Makes sense. So, Steven, will you stick to those two states or branch out a little bit going forward?
So when I start getting tapes now, I do filter, and I'm trying to maybe keep it a little smaller. So just again, kind of with same thing with the servicer discussion is, I think the less states, just the easier it might be to get familiar with those and easier to manage. So I have put some more thought into what states I want to go in, and I think where I'm at now, and then again, kind of expanding the criteria to Jamie, what you have with Labrador, I think is probably my bubble right now, and we'll see how it goes. But again, I'm not looking to purchase 75 assets or 50 assets this year. My goal starting out was 5 this year. So I think the state restriction that I have right now is not inhibiting me from hitting my purchasing goals.
Makes sense.
Well, it's interesting because you mentioned, trying to stick to a few states. And one thing that was popping in my head during this is if you have an attorney that services several of those states, it's also you can stick with that one attorney. You build a better relationship with them, and relationship with the attorney is key because few things. One is dependent on how they bill you. A lot of times you can pick up the phone after you've done several, cases with them and just ask them questions, and they're not going to, bill you on the clock and stuff like that. So that's important, but they just start to get to know you. And then if there's states later on that they may not do, you can pick up the phone and say, hey, I know you're not in this state, but you're in 12 other states. I'm guessing somebody or can refer me to somebody in this other state. Because I think that's important as well, because one of the things I caution people on is I see a lot of people throw these lists out there with all, attorneys in all these states and so forth. And honestly, a lot of them are just names that, okay, have you ever used them? No, but this person has. Then you talk to that person. This person's like, well, no, I didn't use them. This person referred me to them. And then it kind of come full circle. And it's like, almost like nobody actually ever used that person. And I had an instance where I had an attorney in the Southeast who, was referred to me, and it's the only attorney I fired not once but twice.
Well, and things change too. I mean, attorneys are people. Businesses change, and you can't just have a static list over 4 or 5 years. Go check the list. So it's important to update those things and talk to other people for references,
especially during COVID. Because one thing I think a lot of people don't realize is foreclosure attorneys right now are hurting big time because of these moratoriums. So a lot of them have laid off a lot of staff, and it's really unfortunate. I was talking to an attorney about this yesterday because all these states, when they put these moratoriums in, they don't update it until the last second. So like there's one state I invest in that the 15th of every month it gets extended. And, lo and behold, on that 15th day yesterday, they extended again. So as an attorney, it's like, how do I manage my practice when I don't know when to bring people back on? And it's almost like I have to wait. And basically people who are sitting at home wondering how long is this going to last, they're letting them wait. And the states are actually doing it intentionally. I actually got an email from attorney. My attorney received an email from somebody within, I'll say, a jurisdiction who said, yes, we are told to wait till the 11th hour before we announce any more extensions. And I'm like, wow, this is insane. But, so
crazy.
Yeah. So Steven, as we wrap up this episode, where do you see yourself going in the next 6 to 12 months?
Like I said, my 2021 goals were to purchase 5 notes this year, and we're at 2 so far. So I think looking at another 3 note purchases is where we see ourselves going. What I'm battling with right now is performing or non-performing. So I'm looking at both, but maybe I was going to ask a question to you guys, like, And when you were starting out, kind of weighing the pros and cons of going performing or non-performing, where would you suggest folks, again, with maybe one or two no purchases, how would you expect them, or what advice do you have for expanding their business? Would you recommend performing or non-performing, or does it not matter?
I'll let you
Go
answer
ahead, Chris.
Okay.
All right. Um, I'm not going to say my opinion has changed a little bit, but I recommend people start out with performing notes. I mean, that have equity. Yes, you're going to run out of money sooner. You're going to kind of get capped a little bit quicker, but just getting 2 or 3 notes under your belt that are performing, I think, is a good idea. Ways you can expand. I mean, joint ventures with non-performers work if done legally, and then you can certainly sell partials on. I think I used to think joint venture on a non-performer was the way to go initially, and then partials were more advanced. I'm not sure that partials are more advanced than a joint venture. So I think
They're
there's a lot
easier.
more going on. Yeah, they're easier, and they can be structured different ways. So I'm now looking back over the last few years. I think I would have gotten into partials earlier, and I'm not doing any more joint ventures currently, so I'm not starting any. So point being, you can take that performer and sell a partial on it. That's one way to expand your business. You're deferring cash flow and going out and buying another asset. So those are 2 ways to kind of get access to capital, I guess, to expand. But I do want to reiterate that you really should have some type of track record before you're doing either one of those options. And so you've been working with us for almost a year now. So I mean, that's a track record right there. I don't want to lead people down the path of, oh, well, I can buy a note and sell a partial 5 days later. I have no idea what I'm doing. It's not what I'm talking about. But those are 2 ways that you can expand your business, because you will run out of cash that's allocated for your business. So it's just kind of my initial thoughts. What do you think, Chris?
It's not a one size fits all answer for people, and the reason I say that is it depends on your personality and your style. I know people who, start out, buy a performer so they understand the process, and then they're like, okay, I kind of understand this. Let me go to non-performing route and kind of get some of this experience. And then there's others who are like, you know what, I'm just not ready, or I don't want to deal with it. I don't have the time, because there is more time involved in a non-performer. So there's a lot of variables to play into that. If you've got, 2 kids at home, and depends on what your significant other does, and how much time you actually have to manage it. Now, I would say on non-performers, if you have a handful of them, you're not spending hours a day on them, but you still need to check on them, or spend every time every week looking at them. Where on performing loans, it's, hey, I can check this thing once a month. Really, did they pay or did they not? And focus on other things. And that's kind of one of the other components to it is, if you have performing, and you have time, do you focus your time then on some marketing or some other aspect of the business that could eventually lead to, if you're looking to raise money, or network, or tell people your stories? Because you've done, for you, it's a unique instance because you've worked with Jamie, so you can share some of those stories. Hey, while I was working with this person, here's some of the stuff that I've learned, and share those stories, which people like to hear. Most people don't have that, which is a benefit to you. But even on the performing loans, if you start telling your story and networking, and just start sharing that experience, eventually over time, you'll kind of, again, grow your brand, which can be beneficial. So I'm kind of answering it like a politician, in the sense it's
No,
not
it's true though.
one
It
size.
depends.
Yeah, it depends. Now, from what I know of you, based on some of the conversations we've had, I think you would do fine on non-performers. I think you have the background and experience, and the, basically, you're not a, somebody who's going to get all fired up, or all, discombobulated because of something going on. Some people are just, sensitive in that, and things happen. It's like, oh my God, I'm never going to do this again. You seem like the type of person like, yep, it happened. Okay, now what do I gotta go do? Fix it. If you're one of those people, then yes. But if you're somebody who is easily distracted, or sometimes sensitive in the way of, I don't want to have to deal with conflict, because non-performing is conflict oriented. I don't care what anybody tells you. You're going to face conflict all the time. I got an email last night at 11 o'clock from an attorney on something. And it was one of those things where if I was probably where I was with you, or I was when you started, if I was, 3 months in, I probably wouldn't have been able to sleep last night. And I'll tell you, guess what? I slept like a baby, because it's something that I'm just so used to dealing with. So it's, you kind of got to, go through that process. And it's a matter of, when are you mentally ready to, go through that process? And the other thing I'll mention to it is, not only you, but if you got a significant other involved and so forth, or just knowing kind of when are they mentally ready to go through it as well, because, you should keep them informed on certain things, because the last thing you want to have happen is, have a borrower who sends a QWR, something doesn't happen, and, they file a lawsuit or something, and then, somebody from the sheriff's office comes knocking on your door with a complaint. That would be something that's very, wouldn't go over well.
Yeah, just to kind of piggyback quickly on that, I just really do think that's it. The answer is it depends. It always does. I was talking to a note investor yesterday. I had a call with someone who's an older gentleman, probably mid 70s, and he's bought seconds, and I guess in my mind I have this generalization that if you're retired and I don't want to call him elderly. He doesn't seem elderly to me, but getting up there a little bit in age, maybe you want to go the more passive route, partials, funds, and that kind of thing. Well, he said, I'm not interested in performing notes. Because think about it, he's got time, and he's very much with it mentally. This isn't a physically demanding thing, no matter what. So he's interested in non-performers. So it's really hard when people say, what should I do? Performers, non-performers, first, second, CFDs. I think what Chris and I try to do with the podcast is maybe just talk about what's worked for us or what hasn't worked. But everyone's situation is different, with the family or finances and time and goals, so it's really, but again, it gets to what I love about notes in real estate is you can make it what you want. You can approach it. If you want to buy your 5 notes this year and never buy another note, nothing wrong with that. So it's one thing I love about it.
Yeah, like where my head's at and why I went non-performing was, again, that just initial curiosity and interest in the financing game, right? And that's, you don't necessarily get that with performers, if they just keep paying. I hesitate to say boring, because it's not boring.
It's kind of boring. There's more work on the bookkeeping end, but it's kind of boring.
There's more excitement, right? There's more creativity and workout solutions with non-performers, obviously. So I think that's kind of what led me down the non-performing route. So we'll see. I think for us, at least, there's got to be some sort of balance. I mean, obviously the income from performers is nice to have, just to kind of sustain and maintain. But again, kind of the business structure, and I think the profitability is really in the non-performers. So.
Absolutely.
So as we wrap up this episode, Steven, do you have a note and bolt for people? You kind of mentioned one earlier, but it's been 45 minutes, so I forgot what it was. But do you have something for everybody?
I might, because I can't remember either. I'm gonna maybe do another one. So,
sure.
As we're looking at growing here at Phoenix Notes, I've learned to not be shy about bidding. So I've seen stuff come through now, and I'm running deal analysis, and I've learned that it just doesn't hurt to bid, right?
I know firsthand.
You're not gonna. Yeah, you're not. I've been on Chris's assets. I didn't get them. Live and learn. I was short, so that's just part of the process. So I would say don't be shy to bid, especially if you're starting out. Be conservative in your numbers. You get feedback, right, Chris? You were very open and said, "Hey, you were below the mark," and that's just part of the cycle and part of the process. So bid.
Yeah, and I just add to that is not only bid, but then ask if the seller, hey, can you tell me what it sold for when it closes? Because I don't have a problem, when somebody, I'll wait till it closes, because I don't know, something could happen where the person backs out or something like that. But, I'll let, after I close these deals, I'll probably, if Steven reaches back out, because I'll forget probably by that time. But if you reach back out and says, hey, what these assets end up going for? I won't typically say who they were sold to, but I'll give you a ballpark of, yeah, they went for around 25 grand and you were at 13, or they went for 20, or kind of give you an idea. And that's very important information to have, because as a new and no investor, you don't really know where things, you hear what people say, but it's, how accurate is that information? And for me, and again, sellers could, blow smoke up your, what, and give you bad information to make you try and bid higher on other ones. I wouldn't do that. I would, I'll tell people, yeah, basically sold, for, or, I'll say, or they were selling, most of them sold, the performing sold for, 80 cents or 85 cents. And the nons went for, and the ones you bid on were going for, 45 cents or something along those lines. I have no problems reaching out to people after the fact to let them know, kind of where they missed that mark. Cause I think it just, as we have this podcast to try and educate people. So I think that's just another form of us giving back.
Yeah, that's a great feedback advice. Loop. I bid on an asset, and a performing one in Michigan for, I think it was like 29K or 29.5 is what I bid. And I got an email saying it sold for 36. I'm like, holy smokes. So I had to like go back to the calculator, and it's like, I must have either missed something, or people are willing to pay what I'm not right now. So
no, I had somebody recently bid on an asset that they overbid, and I went back to them and I told them, I said, go back and check this, and you drop your number because you're bidding too much. And it was an asset that's in my own personal portfolio. And this is somebody who I think is somebody in the business who's, I think, going to go a lot of places, but and they were newer as well. But I won't take advantage of somebody who's a non-performing asset. And most sellers, I do know a seller that did that with me early on, so I highly respect them for that. And that just shows the integrity that person has. And we're not talking tens, thousands of dollars to drop the price, but it was more than $1,000 to move that number. And if people overbid on stuff like that too, in instances in my own personal portfolio, I'll let them know, like, hey, look, you need to go take another look at that, because and run your numbers again. So usually when somebody said, and that's kind of the wink of, you're too high. Now, I don't know if, Jamie, you do anything like that or so forth, but
I was going to say, you've never told me that when I bought notes from you, Chris. I'm kidding. No, I didn't. That's a key point. It's like, this is a long-term play. This is a relationship business. You want people to buy from you again, and you also want them to succeed, right? Yeah. So this isn't about ripping people off and never looking back. I mean, so.
No, actually, I got a call a few weeks ago from a woman. I hadn't heard from this woman like a year and a half, and she wanted to convert. It was actually in Missouri, a CFD to a note, and she was asking about it and stuff. And I said, "Hey, isn't this the one you bought from me?" And she's like, "Oh yeah, it is." And I said, "How's it doing?" And she bought it as a non-performer. She's like, "Awesome. The person's this, that. We want to convert it because we're going to sell it and we're going to make all this money and stuff." And I'm like, "Great." And she's like, "Oh, you're not upset you didn't keep it?" I'm like, "No." I'm like, "I sold it for a reason. I didn't want, wanted to move it to get my money to put it elsewhere and stuff. But I'm happy when people buy assets from me and make money. And that's why, Jamie, I'm always happy with you, because you're always making so much money off the assets I buy."
Some of them have yet to play out, but no, it's true. It's not a cutthroat thing. So hopefully we can all benefit from sharing information like this, and we can all, what's your saying, Chris? Something for this year. We're all succeeding together. I can't remember the term you were using.
Co-elevate.
Yeah, co-elevate. So. Yep, exactly.
Cool. So I kind of just threw my note and bolt in there about not only kind of adding on to Steve's about bidding, but trying to get the information after the fact, so you have some historical numbers. Jamie, go ahead, buddy.
I would say, so once you close on an asset, Steven, this could be for you, make sure you actually review the hard collateral file, the trailing documents, but the actual physical collateral file. Because it is easy. I can tell you it's easy for me to move on to the next deal. And so, or whatever, go back to asset management, focused on the assets we already had. And depending on what you're doing, whether you're using a third-party custodian, have them do it. Make sure you have all of the original especially the original note and things like that. So my note and bolt is to, your transaction is not actually complete until you've reviewed the collateral file, and then obviously you've got to do some recording and things like that. But actually check the hard collateral file. Don't just rely on copies that were in PDF or something like that.
And check it, but when you open it, just don't take it and say, "Oh, I got this thick folder." Make sure there's stuff in there as originals. Can you deal with stuff that's not originals? Yes, I have many loans that they lost the originals, but I got lost note affidavit with copies of information. Jamie, I know some of those New York loans, I think also have some of that information. It's just important to understand if it's not there, is it detrimental or is it something that can impact significantly? Certain states, if you don't have the original stuff, it can be, very impactful. Basically, you might not be able to do anything on that loan from that purposes. But in most instances, if you have the lost note affidavit, and it depends truly on the state, I think for the most part, there's stuff you can do, but that's where you got to get with your attorney. Now, if you find out after the fact that the collateral is not full and it's just PDF copies, if you notify that seller and it is something that's an issue, and it makes the loan unsecured, from that perspective, you could get a refund. You're not going to probably get refunded all your due diligence expenses and stuff, but you could say, "Hey, look, this isn't what I bought. You don't have any of the collateral. I can't do anything with this loan." So from that purposes, I need my money back. And a good, legitimate seller would say, "Yep, okay, sorry, here you go."
Yeah, if it's right away, but if it's a year or two later, sorry.
Yeah, a year or two. If it's a year or two later, I would say the same thing. I'd say, sorry, I had, and we're running a little long now, but I had a loan where I sold to somebody and I sent all the collateral to their servicer, and they emailed me last week saying, "Hey, we need the original collateral, and you need to provide all this information, and we need this and that," because actually the borrower paid off the loan. So they were looking for, I'm not even sure what. I don't think they ever recorded the deed into their name, but I finally went back to the person. I said, "Look, you're asking me, I sold you a car, a year and a half later, your car gets stolen, and you're calling me to say, where's the car?" I'm like, "I have no idea where this stuff is." I'm like, "Here's the information I sent. Here's the date I sent it. Here's a confirmation." So another little note in bold is, when you send stuff like that, make sure you send it by a way that can be tracked. So don't just put it regular mail. So
good point.
Well, thank you everybody for listening to and watching us on this episode of the Good Deeds Note Investing podcast. Thank you, Steven, for also coming on today. As always, please leave us a review on your favorite listening station. And as always, go out and do some good deeds. Thank you, everybody.